Today, Bitcoin and Ether drop as we close out the week. Core Scientific and CoreWeave are in the red as the crypto miners' shareholders prepare to vote on an acquisition by the cloud infrastructure technology firm. And Charles Edwards, founder and CIO of Capriole Investments, breaks down the digital asset treasury trend, which he says could end in a, quote, volatile unwind. Welcome to CNBC's Crypto World. I'm Brandon Gomez. Major cryptocurrencies are in the red to end the week, with Bitcoin trading under $107,000 as of noon Eastern. Ether fell below $3,800 and XRP dropped 2.5%. According to a JPMorgan note yesterday, crypto native investors are likely behind the correction in crypto markets since last Friday. Analysts also noted that unlike Ether, Bitcoin CME futures and spot Bitcoin ETFs have not seen significant liquidations since then. Over the past 7 days, Bitcoin was down 8.5% as of noon, facing back-to-back weekly losses and its fourth weekly loss in the past 5. This week marks Bitcoin's worst since February 28th of this year, when it fell more than 11%. Ether was lower by more than 5% over the past 7 days, posting consecutive weekly losses and its fourth weekly loss in the past 5. XRP was down 14% over the past 7 days, also marking back-to-back weekly losses. Now, taking a look at crypto-related stocks, Core Scientific and CoreWeave both down more than 5% at noon, as shareholders prepare to vote at the end of the month on the cloud infrastructure provider's plans to acquire the Bitcoin miner. But that plan has hit a snag. Core Scientific's biggest shareholder, 2C's Capital, reportedly opposes the deal, saying it undervalues the miner and exposes shareholders to substantial economic risk. The deal's uncertainty has hit the stock, along with the ongoing challenging market for Bitcoin miners, despite the potential benefits of the acquisition. Earlier this week, Core Scientific's board reportedly urged its shareholders to vote for the crypto miners' proposed sale to CoreWeave, which takes place on October 30th. All right, jumping straight to our main story, Crypto World's Jordan Smith spoke with Charles Edwards, founder and CIO of Capriole Investments. Back in August, Edwards put out a report called The Treasury Company Bubble, where he warned that digital asset treasuries could reach saturation and face a, quote, volatile unwind. He discusses that report with us as more and more DATs come to market.
So let's talk all about these DATs that are popping up everywhere. We hear more and more about them every day. How did we get to this point? Because I feel like it's really a 2025 story that these digital asset treasuries are going public in such fervor right now.
Yeah, it's a perfect storm. We have about 186 DATs right now. And I think it's two main factors. First, we have MicroStrategy, which was an amazing success story the last 5 years. They outperformed the entire S&P 500, and they basically did it by buying the best performing asset, Bitcoin, and arbitraging low cost of debt from traditional finance markets. They've beaten NVIDIA and everyone through that period. So I think people have looked to that as a case study and wanted to replicate it. That's the first element. The second is, I think, the perfect storm on the political and legislative side. We had a change of administration, obviously in the US, start of the year, and that really signaled the green light, the on-ramps to capital into crypto. Rewind 2-3 years, it was very hard to move significant money in this asset class. A lot of the banking on-ramps were not functional and shut down completely. And that completely flipped. We've had 5 or 6 legislation pieces through that period as well that have supported crypto, whether it be the Genius Act or the US Treasury Reserve for digital assets. So I think institutions now have the comfort that they can enter this space in size, and that's really been an enabling factor, as well as underlying fundamentals such as growing money supply globally and other factors which are really supportive of Bitcoin adoption.
I want to point to your article, The Treasury Company Bubble, that you wrote back in August. And you mentioned that at the time, treasuries held about 5% of Bitcoin's supply. Since then, we've only seen more and more of these companies pop up, not just for Bitcoin, but for altcoins as well. And I'm just curious if this kind of accumulation that we're seeing is sustainable. I mean, you call it a bubble at the title of your article. So is it sustainable in your view?
Yeah, good question. It's now at about 12%. So it's gone up. Institutional supply has gone up from 4 or 5% 2 years ago to 12% of total Bitcoin supply, which is incredible. It's been a great supporting factor on price. Today, for example, the institutional demand for Bitcoin, both Bitcoin ETFs and treasury companies, is about 500% of the daily mine supply. So it's a really big, demand push from the baseline, which historically has been very supportive for Bitcoin price. That said, I question the incremental value add of number 200, 300, 1,000 treasury company, because if you list in the US now and you're a treasury company, what are you offering over and above the other 50 or 100 treasury companies to entice capital? And the answer is typically not much. And that's why we've seen over time the MNAV of all these treasury companies compress. And that's basically the value of the company to its Bitcoin holdings. So if the company is trading at less than the value of its Bitcoin holding, its MNAV is less than 1. And that creates a number of problems.
Yeah, I want to talk about MNAV in just a second, but to go back to your point there about, sort of the value add for these investments, can you explain why someone might want to invest in a digital asset treasury versus the asset itself or a Bitcoin ETF? I mean, it seems that, every day there's a new vehicle to invest in crypto. What's the selling point for these DApps?
I think at the end of the day, the main selling point is leverage. So trying to achieve a better yield on their Bitcoin. So they're trying to get a lot of those treasury companies are selling some form of Bitcoin yield. And the intent is that if you put your Bitcoin or equivalent amount into a treasury company, you can expect to have more Bitcoin in the future. That's the goal, but it's just, in my view, not sustainable long term. And we've seen that because the yields compress over time, and it's you're fighting an uphill battle basically against an asset which is limited supply.
Mm. Yeah, and when you mention MNAV, that drop in a value of a company's Bitcoin holdings relative to the price of Bitcoin, can you talk about some of the top reasons that you're seeing that drop in value across these different treasury firms?
Yeah, it's a few things. I think it's an element of saturation because there's almost 200 treasury companies now. If we compare it to something like the investment trusts of the 1920s, a very similar investment vehicle where these companies would go and raise capital from investors and buy stocks. People at the time were saying that stocks had a scarcity value to them. The companies back then in the 1920s were launching at 2 to 3 times a multiple of their net underlying assets. So they were able to then go and buy more and basically leverage up. And they were a pretty big driving factor for the 1929 collapse. The difference between then and now is that there was a lot higher use of leverage, often 3 times to 10 times at the end of the peak. But today, fortunately, the debt to leverage ratios are quite low at a healthy sort of 25 to 30%, but it's definitely something to watch because as MNAV goes less than 1, you can't issue equity because it's dilutive, it's just bad for shareholders. When MNAV is greater than 1, you can issue equity, it's accretive, and then everyone benefits from the positive Bitcoin yield. But when it's less than 1, you can't really do that. So your options are limited. You can issue debt and increase your leverage, and that increases that risk factor. Or you could sell some Bitcoin and buy back your shares to close the gap a bit. Also not really great for your strategy and for Bitcoin generally. So the incentive structure becomes aligned over time to more use of debt. If I'm number 100 or 200 treasury company in the US and I want to offer my investors more yield so that they invest with me, at some point, if my MNAV is less than 1, I have to use debt to generate that yield and stand out, right? That can work for a while. And that's where my concern is that at some point, we get to a tipping point where there's so many of these companies and they're trying to compete, they're going to have to use a bit more leverage, and people will take that risk, I think, to stand out. And then you get a growing risk factor for over leverage to the upside.
How are you advising clients when it comes to these digital asset treasuries? Because I would argue that, they're not all created equally. You've got things like MicroStrategy, which has been around for a while. It went through that meltdown in 2022 compared to some of the ones that are launching days or even weeks ago. How do you look at those two types of digital asset treasuries, the long-term ones versus the short-term ones, and how are you talking about them at Capriole?
I group them pretty similarly. I think for me, the net view is for me that right now it's great for Bitcoin in terms of price and attracting institutional attention and flows. And when Bitcoin treasury companies tend to do well, we see pretty strong flows and correlation with ETFs. So it's good for price. I think short term, 3-6 months, it could be very good for it. But my concern is the longer term as this number goes up. We're tracking all these metrics on our website. Also, buy sell ratios. Some of these treasury companies are selling bits of Bitcoin here and there. The numbers are very low. The percentages are very low. So it's very much net buyers today. But I think that we get increasing risk as MNAVs drop below 1. About 25, 26% companies have MNAV less than 1 now, and it's trending up and it's near a highest level it's been. And the debt ratios are starting to elevate, but they're still quite constrained. So for me, it's something to monitor. It can go much higher. I'm not saying that this is immediately something bearish. It could take years, right? The 1920s, that grew for, the treasury company, the investment trust grew for about 7 or 8 years, but when they topped at about 600. So we could have quite a bit of runway left, but it's definitely definitely some important risks to be monitoring.
Okay, that's all for Crypto World this week. We're back again on Monday, and we'll see you then.